Hi, welcome to the webinar. Thank you for joining us today. I am thrilled to have you today. We have a great topic ahead of us, qualified opportunity zone funds and investing in them. We wanted to cover this topic because we really hadn't done it in detail before. We have 1031 Capital Solutions. Rick Gann is with us from that team, and he's going to be presenting today. Jason was going to be joining us, but unfortunately he wasn't able to, so he will be missed, but Rick, I'm sure, will do a fantastic job. Rick was actually a real estate attorney for several years, and he's now moved into consulting with real estate financing, real estate taxation, and he knows quite a lot about the topic. He's been doing that for over the last 20 years alongside Jason, who is not with us today, but we will go ahead and get started in just a moment. But before we do that, I did want to just bring up that we will have the recording sent to you tomorrow, as well as the PowerPoint slides. So if you miss anything, don't worry too much. We'll send it to you tomorrow. And we'll also be probably doing the presentation for, 45 to 50 minutes, followed by a Q&A. So save your questions for the end, and we'll be covering those as well. And with that being said, I'm going to hand it over to Rick here, or Richard, to get started on the webinar. Thanks, Richard, for being here.
Thank you. Good morning or good afternoon, depending on where you are. Thank you for joining us on this beautiful spring day. I hope it's beautiful wherever you are. And I hope everyone on this call is healthy and safe and coping with the quarantine. We'd like to thank AAOA for giving us this opportunity to speak with all of you. We also want to give special recognition to the multi-talented Alexandra Alvarado. We truly appreciate all of the great work she does on behalf of the association. Again, my name is Rick Gann. I am a managing partner with 1031 Capital Solutions. In case you're losing track of which webinar you're on, today we will be discussing qualified opportunity zones as an alternative to 1031 exchanges. But before we get into the heart of the topic, what we'd like to do that's kind of a fun way just to engage all of you. Most of the people on this call are apartment owners. And so what we'd like to do is have you turn on your chat function. And this might take you a moment to find where the chat function is.
Should be at the bottom of your screen. If you scroll your mouse, you should see the chat there.
And then once you have that figured out, please finish the following sentence on your chat button. And that is, one time, one of my tenants blank. And what we're looking for is one of the most memorable things that any of your tenants ever did at one of your properties. One time, one of my tenants blank. And I'll give you a couple minutes, and then on an anonymous basis, I will read some of these out loud. Mm-hmm. I guess technically you can all see each other, so it's not that anonymous, but.
Yeah, I mean, I love this question that you ask, Rick, on these webinars, because it's just crazy the stuff that comes through. And I mean, other than just not paying rent, I'm seeing a lot of stuff coming through, and boy, is it hard to be a landlord sometimes, that's for sure.
Yeah, there's no better way to gauge how frustrating it is to be a landlord than just hearing other people's stories about some of the wacky things their tenants have done.
Yeah, and I know not all of you can see this because some of them, when you're putting in the chat, looks like some of you are just doing it to the panelists, not to show everyone. I don't know if that's intentional or not, but we can see all of them, and there are a lot on here that are pretty crazy. And you know, I actually wanted to pause here real quick and just let you know, if you do have a story to tell, we have our digital rent magazine coming out soon. So I may be contacting some of you guys, because these stories, I feel like, you know, we should tell people about. They're pretty interesting. So Rick, do you see any crazy ones that are striking your attention?
Well, I see one here, changed the locks and wouldn't let me in. Um, Passed away, you know, unfortunately that actually happens a lot. And that's one of those things that a lot of landlords don't really think about as a burden of ownership until one of your tenants actually passes away. Had a guest who did not want to move out. Here's a good one, left behind an 8-person jacuzzi in the side yard.
Interesting.
Um, Signed a 2-year lease and then vacated the property the very next day. Got arrested and left all furniture and personal belongings behind. Here's one, flooded my unit and refused to pay $25,000 in damages. And I'll pause on this one because, and I talk about this in the book that we have, which I'll mention in a moment. For this landlord who had this situation where a tenant flooded the unit and refused to pay the damages, what we've also seen is tenants flood the unit and then the water causes mold damage, and then they report the landlord for mold and refuse to pay rent because of mold in the apartment that they caused from flooding the apartment in the first place. So we've seen that happen. Yikes, there's a couple of violent ones in here I'm not going to mention, but I'm sorry to hear about that. Here's one about locked his drunken alcoholic girlfriend out of the unit and left her on the landing outside the front door while she pounded on the door and wailed to wake all the neighboring tenants.
Whoa.
That sounds fun.
You know, I'm seeing a couple questions come through in the chat as well. So just a heads up, if you do have questions, let's put them in the Q&A because I don't want them to get too lost here in the chat. We're getting a lot of activity. So Q&A should be an option at the bottom of the screen to the left of the chat. So you can put in any questions there. We'll be sure to get to them, even if we don't on the webinar. Rick is fantastic about getting back to people. He gives very detailed responses.
Yes, I will make sure that every question is answered, whether I get it on answer a question on this Zoom meeting or offline. And I'll leave this out. There's a bunch of really wacky ones on here, but I'll leave it on a positive note. Last one I'll mention, it says, called me to say thank you for being a really nice landlord. Isn't that nice?
That is.
You don't hear about that too much. Okay, well, let's continue. Thanks again for sharing some of your experiences as apartment owners. So what we're going to address today specifically is the basics of qualified opportunity zones, the potential tax benefits of investing in such zones, and how to invest in funds that invest in qualified opportunity zones. And throughout this webinar, just to keep that mouthful of syllables in check, we will use the term QOZ to refer to qualified opportunity zone projects, and QOF to refer to the funds, F-U-N-D, funds that invest in QOZs. So you're going to hear me say QOZ and QOF multiple times over the next half hour. I'm referring to, again, the qualified opportunity zones and the qualified opportunity zone funds. And as Alexandra mentioned, we will leave some time for questions at the end. So please type your questions in the chat box. And like I said, we will do our best to answer either during the call or in a subsequent email. I promise we'll get your questions answered. So before we go any further, I am required to tell you that this presentation is not a solicitation. It is for informational purposes only. We are not making reference to any specific investment or property during this webinar. Past performance, of course, is no guarantee of future results. Although the name of our company is 1031 Capital Solutions, we do not give tax or legal advice. There are risks, naturally, to investing in a QOF, including lack of liquidity and marketability, possible future changes in tax laws, and limited control as a limited partner. And of course, as with any real estate investment, but particularly with development, there are several inherent risks. And those include, but are not limited to, economic risk, supply-demand risk, operating risk, and regulatory risk. In addition to the general risk factors outlined here, every private placement memorandum, or PPM, of a specific QOF investment contains literally hundreds of pages of project details and financial projections and pro formas and disclosures. One of the many benefits of investing in a syndicated real estate QOF or 1031 DST is the amount of due diligence transparency behind every offering. And I can promise you there is certainly more data available in these PPMs for informed decision-making than in any traditional real estate purchase or non-syndicated partnership program. We should also mention that QOFs are, again, private placement securities that can be sold only to accredited investors. And accreditation typically requires a net worth of at least $1 million, excluding personal residence, or a household income for married couples of at least $300,000. As I mentioned, my name is Rick Gann, or Richard. My office is in Lake Oswego, Oregon, outside of Portland. My partner, Jason, is in San Diego County, and we also have satellite offices in San Francisco and Seattle, as well as team members who work remotely from Denver and Phoenix. I'm an attorney by trade, as Alexandra mentioned, and my partner has an MBA. We both have been working in this industry together since 1998. Over most of that time, we have been syndicating tax-efficient real estate investments such as 1031 programs, REITs, and QOFs. I encourage you, please, everyone, to visit our website, 1031capitalsolutions.com, where we have copious articles and blogs and videos and great educational content. In a nutshell, we are a boutique financial services firm that focuses on helping individual property owners retire from being landlords. And on that note, in May of last year, we published a book on this very topic, which is available in both print and electronic formats on Amazon. Before the call's over, I'll give everyone an opportunity to contact us and request a free copy. And we are happy to send everyone on this call an actual copy of the book. We just need your name and address, and I'm happy to send one out to you. Although our firm is small, our back office broker-dealer is actually one of the largest brokers of DSTs and QOFs in the United States, which gives us at 1031 Capital Solutions a tremendous advantage in the marketplace, as well as access to best-in-class due diligence and compliance resources. So at this point, we're going to get into the basics of qualified opportunity zones and funds, starting with an understanding of where all this comes from legally. And the genesis for the QOZ law actually traces back to 2007 in, of all places, the hills of Western Tanzania, where billionaire Sean Parker, after his famous Facebook exit, was observing the United Nations work on malaria prevention and economic development. And we are told that Parker was struck by the poverty there and saw little hope that the region would ever attract the kind of private placement that could deliver real progress. Meanwhile, back at home, he noticed similar problems in rundown areas around places like DC and San Francisco. And at that time, according to Parker, people in the US were sitting on large capital gains, as they are today, with low basis and huge appreciation, representing literally trillions of dollars sitting on the sidelines of the economy. And as the story goes, Parker started thinking, well, how do we get investors to put money into places where they normally wouldn't invest? So he ultimately started the Economic Innovation Group, backed with an initial outlay of $15 million, which focused on the causes of inequality and the potential of using tax policy to help draw profits out of portfolios and into poor neighborhoods. And this think tank quickly focused on crafting a policy that uses tax incentives to move investor cash into struggling communities. By 2016, a qualified opportunity zone bill had won the support of 22 congresspeople on both sides of the aisle. For Republicans, it promised a tax break, a market-based solution, and a way to put power in the hands of state and local governments, while Democrats liked the prospect of rerouting dollars into areas in need of funding. So the upshot of all this was ultimately the Invest in Opportunities Act of 2017, and that added section 1400Z/2-2 to the Internal Revenue Code, which establishes the rules and benefits of investing in funds that invest in qualified opportunity zones. So we'll call this subchapter Z for short, and subchapter Z allows you to sell any appreciated asset that would otherwise trigger a capital gain and defer the taxes by reinvesting just the gains into a QOF. So let me touch on a few of the finer points here. First, in taking advantage of this law, you are not limited to selling real estate. You can use a QOF to defer capital gains from any asset. That could be property, but it could also be a business that you sold, or a stock that you've held onto for years, or a pot of gold for that matter. Any asset that was highly appreciated that would have otherwise triggered a capital gain tax is available for reinvestment in a QOF. Second, unlike a traditional 1031 exchange, you do not have to replace the entire asset you sold. Again, you only have to reinvest the capital gains. And if you choose to reinvest only part of the gains, that's okay too. Third, you have 180 days from the time that you sell whatever the asset was to reinvest your gains, unless there has been an emergency declaration, which happens to be the case right now. People who sold as far back as October 2019 can still reinvest through the end of this month. And so we'll talk more about that in a few minutes. But if you've sold any asset that otherwise would have triggered a capital gain, you can reinvest. And in fact, if you already reinvested, if you already paid the taxes on a capital gain, you could even go back and amend your tax return and take advantage of a QOF. So the window is still open going back to 2019. And like I said, I'll go into more detail on that in a few minutes. So if you meet the requirements that I just mentioned here, you will be able to defer all of your federal capital gains taxes. Let's suppose you sold a rental property last year and you decided to do a 1031 exchange after it was too late. Well, no problem. We can still do a QOZ tax deferral. You would simply take the profits from the sale of your property and invest them in a QOF, and then instruct your CPA to file a form with the IRS on your tax return. As a result, you are now able to defer your tax payment until December 31st, 2026. Even better, if you invest in the QOF before the end of this year and hold the investment for 5 years, you effectively receive a 10% discount on your federal gains taxes. But wait, there's more, as they say. Suppose you had $1 million of gain to reinvest in a QOF right now. You would get to defer that gain until you pay your 2026 tax bill in early 2027. As we just discussed, the IRS will reduce your gain by 10% so that you would only pay tax on $900,000. Assuming a combined federal and state tax rate of 28%, you would save $28,000 in taxes, not including the time value of deferring that payment for 6 years. Now, if you continue to hold your investment until 2031, 10 years from now, before liquidating, the IRS will disregard all of your additional appreciation. Even if your original investment of $1 million in the QOF doubled to $2 million in 10 years, you would receive that entire $2 million payment tax-free. That's a pretty compelling tax benefit. So just so we're clear, I want to emphasize that under the Qualified Opportunity Zone rules, there are actually 3 distinct tax benefits for investing in a QOF, all wrapped into one investment. First, you get to defer your original capital gains tax until the spring of 2027. Second, if you invest before the end of this year, you get a 10% discount on the deferred capital gains taxes. And third, if you hold the QOF investment for 10 years, all of the new capital gains will be disregarded for federal tax purposes. Now, you may have noticed that I've used the word federal a few times. That's because a handful of states, including California, have chosen not to conform with federal QOZ laws. And if you live in one of the non-conforming states, this means that you could end up deferring just your federal capital gains tax, but not your state tax. But that is still a considerable deferral and savings. As I mentioned previously, the law, as it was written in 2017, allows a taxpayer to wait up to 180 days before investing his or her gains into a QOF. I should note here that unlike a 1031 exchange, you do not have to use a qualified intermediary to invest in a QOF. You could have already reinvested the proceeds of your sale into another asset, into another property, and simply withdraw an amount equivalent to your gains from your bank account to invest in a QOF. Even if you have not given a single thought to investing in a QOF until the 180th day, you can call me or my partner Jason now and invest into one or more QOF funds. However, due to COVID, the federal government temporarily extended the 180-day deadline under IRS Notice 2110. And as a result, here are the revised deadlines. Capital gains that were realized between October 4th, 2019 and October 2nd of 2020 now have a deadline of March 31st. In other words, 8 days from now. So if you realized any capital gains in any asset, property or otherwise, between October 4th, 2019 and October 2nd of 2020, you can still defer the taxes on those gains by investing in a QOF in the next 8 days, which is entirely plausible. And then going forward, the deadline to reinvest those gains is continues to be the 180-day deadline that I mentioned. Most QOFs are formed as partnerships or corporations, but we've also seen them organized under a REIT structure. So there's a few different varieties. Subchapter Z requires a QOF to hold at least 90% of its assets in QOZ property. The rules also include a safe harbor for maintaining a reasonable amount of working capital. To comply with this rule, there must be a written schedule for the expenditure of the working capital assets within 31 months of receipt of the funds. A QOF may also extend the working capital safe harbor period to a maximum 62-month period if certain additional requirements are met. And furthermore, if the property is located within a federally declared disaster area, it may receive up to an additional 24 months to expend its working capital. Therefore, a QOF could potentially have up to 86 months to spend its cash. The point of all this is that a QOF has flexibility under the law to deploy development capital, but complying with the rules requires considerable resources and expertise in following these tax regulations. And this is why Two guys and a dog should not try to form their own qualified opportunity zone fund and raise capital from their buddies. The best QOFs are sponsored by large institutional real estate operators who are already in the business of sponsoring other tax-driven funds like REITs and DSTs. So admittedly, we have gotten ahead of ourselves here a little bit. You may be saying to yourself, there's been a lot of talk about funds, but what exactly is going on inside of a qualified opportunity zone? Well, as I mentioned, the idea behind QOZ investing was to incentivize investors to move sideline capital into underfunded neighborhoods. After some bureaucrats developed the basic criteria, the task of drawing boundaries around these zones fell partially on the governors in each of the 50 states. As you can imagine, this was a highly politicized process, and we can presume that many influential developers with projects already on the books may have vocalized their strong hope to be included in these zones. So based on these requirements, you might have thought that, wow, only a handful of blighted neighborhoods would end up on the list of opportunity zones. Instead, as a result of all the politics behind the scenes, there are actually 8,700 plus zones that qualify for incentivized investing under the 2017 law. Moreover, these criteria that, for establishing the QOZs were applied in 2018 to census data from 2010, when many census tracts had not yet bounced back from the Great Recession. And it's quite likely that many of these zones would have exceeded the maximum income thresholds if the boundary drawers had been required to use 2018 data instead of recession data. The upshot is, despite the ostensibly good intentions of the QOZ law, much of the money to be invested in QOFs will go to projects that likely would have been built regardless of the zone boundaries, on the basis that the economic and demographic conditions already supported the demand for the new apartment building or the new shopping center or what have you. As a result, depending on the zone and the project, QOF investors may have the opportunity to receive the tax benefits under the QOZ rules without necessarily taking on quite the same risk that we might otherwise associate with building in truly poor or blighted neighborhoods. The failure and ultimate repeal of community redevelopment law in California has proven that real estate developers and bank underwriters generally do a better job in developing profitable real estate projects than city council members. So you really want to invest in projects that pencil out, regardless of government intervention or tax incentives. And that's a driving philosophy for us in how we steer people to what we think are the better QOF options based on what's out there. So what exactly constitutes qualified opportunity zone business property? Well, in a typically circular definition, the IRS defines it as tangible property used in an active trade or business of a qualified opportunity zone fund. What this really means is that the property has to be acquired by the qualified opportunity zone fund. More importantly, the QOF, the fund, its property has to be substantially improved. That's really the key. The QOF has to buy the property in the zone and then has to substantially improve the property. Effectively, if you are the operator of the fund, you have to double your basis in the property, exclusive of the cost of the land, within 30 months. Again, The minimum requirement to qualify is that you have to substantially improve property that you've purchased inside of a qualified opportunity zone, and the IRS has determined that that substantial improvement is met if you double your basis in the property exclusive of the land. And this is why most of the QOZ investment projects are development or redevelopment deals. If you are starting with raw land or a tear down property, it should not be difficult to double the cost basis of the non-land portion of the investment in 2.5 years. Because really, if you're excluding the land and you bought raw land, doubling your basis means basically any improvement. So it is not difficult to meet the minimum requirements, but it does require development activity. So of course, like many acts of Congress, the first pass at legislation left some open questions that needed to be addressed, especially when you're dealing with tax regulations. Congress will pass something and then leave it up to the bureaucracy to figure out rules to enforce. And so ultimately, additional rules had to be passed to make the QOZ law workable within the existing tax structure. And one of the themes of the 2019 regulations was to emphasize that the development of projects should actually enhance the economic activity in a particular opportunity zone. For example, replacing an old strip mall in an area that employed 25 people with a brand new warehouse that employs 15 people may not help that particular neighborhood with a net loss of 10 employees, even if it represents a more profitable use of the property for the owner. So what the regulations were trying to do is trying to encourage development that was actually going to improve the economics within the qualified opportunity zone, not just creating a more profitable project for the developer. And specifically from those regulations, multifamily residential development was deemed to be a qualifying use of property. And a QOF can substantially improve a development project that has already started, provided that it acquires the property before the original developer receives a certificate of occupancy, meaning that the Qualified Opportunity Zone Fund, the QOF, is not required to start from scratch, but can pick up a project that has started as long as it's acquiring that project really before it's completed. And in multifamily, that means receiving a certificate of occupancy. And this, again, gives QOFs the flexibility really to invest in a greater array of development projects. The QOFs that are out there today raising capital were able, under these regulations, to look not only for raw land opportunities, but also to look at development opportunities that were they'd already broken ground, but still had room to grow. Finally, in a taxpayer favorable move, the regulations adopted a gross approach to Section 1231 gains, meaning that gross Section 1231 gains can be deferred into a QOF and are not first required to be netted against Section 1231 losses. If it weren't for this rule, investors would have to wait until the end of the tax year in which they sold their asset to determine what their net 1231 gains were. If you are not sure what I'm talking about, the good thing is you don't have to worry about it. The rules took care of that. So now that we have a basic understanding of what a qualified opportunity zone is and what a QOF is, I'd like to walk everyone through an illustration of how a QOF can actually generate significant distributable cash for investors not too long after the property is developed and stabilized. Let me preface this illustration by saying that this does not represent any particular QOF investment. This is merely a hypothetical illustration, and there are no guarantees that any QOF will experience enough appreciation to generate debt finance distribution. Nevertheless, I think this is a reliable illustration to understand the concept of what some QOFs are hoping to achieve. And for those of you who are interested in QOFs or maybe considering options for deferring taxes into a tax efficient fund, either Jason or I will have a conversation with you, meet with you virtually, on the phone, in person even, and establish your accredited status and so forth, and then be able to share with any of you actual details on specific offerings. But for purposes of this broader presentation, I am limited to really discussing these concepts in the abstract. So with that said, let's suppose a new QOF apartment project starts with $40 million of investor equity. They've raised all of their $40 million of funds, and they've gone out and they've obtained a $60 million construction loan. So they now have $100 million of capital for development. Now, let's suppose that after this property is developed and constructed, it produces an initial net operating income of $6.5 million. $6.5 million of annual net operating income is coming out of this developed apartment community. Let's further suppose that the capitalization rate, the cap rate, for this type of property in this location is 5%, meaning that someone who is going to buy this property would require a 5% yield on their investment. That's the definition of a cap rate. And therefore, by applying a 5% cap rate to $6.5 million of net operating income, the imputed value of this apartment project is now $130 million. And if someone were to come and appraise the property at that time, they would determine that the marketable value of the property is $130 million because the cap rate is 5% and the NOI is $6.5 million. What that means is we've achieved in this project $30 million of value has been created by investing the $100 million into the project. At that point, the original loan that we mentioned of $60 million is now only 46% of the value of the property. And this gives the QOF the opportunity to refinance the entire project and go and get a loan to pay off the construction loan with a permanent debt, a permanent loan at a 65% loan to value. And 65% loan on $130 million property would be an $84.5 million loan. After the construction loan is paid off, there's now $24.5 million of loan proceeds sitting in the bank available to distribute tax-free to the investors. If this distribution were to occur before the spring of 2027, then the investors can use these proceeds to pay the taxes that they deferred back in 2021. Of course, QOF investors should not depend on a large distribution like this, and as a plan B, should have other funds available to pay their taxes in case the timing doesn't work out in the QOF. But if everything goes according to plan, this strategy is available in some QOFs to provide the liquidity that clients will need to pay the taxes on the gain that they deferred way back when they invested in 2020 or 2021. If it's not obvious yet, let me point out that once you make your capital gains tax payment on the property that you sold back in 2020 or 2021, your tax obligation regarding this investment is now over, provided that you continue in the QOF for a few more years, for a total of 10 years. After you hit that 10-year mark, and in our example, this would be in 2031, when the QOZ liquidates, you receive a full step up in basis. And by the way, this not only wipes away the appreciation, but also the depreciation recapture tax. To the extent that you benefited from any depreciation deductions over the life of the fund, and you will have, you will not have to pay the tax the way you would in a normal real estate sale. In this respect, a QOZ gives you, or QOF, gives you the same benefit as a decedent's step up in basis, except you don't have to die to get it. So again, a compelling tax benefit in that you're going to pay your deferred capital gains tax 6 years later using funds distributed from the fund in this example, and then after that, no longer be responsible for any taxes going forward, provided that you hold the investment until 2031. Okay, to see how the potential tax benefit of a QOF translates into real dollars, we have a final illustration here. And again, this is merely an illustration and not intended to be tax advice. So let's assume that you sold an asset with $1 million of gains in 2020 and reinvested the gains in a QOF. Let's also assume that your combined state and federal taxes on your sale would have been $287,000 in 2020. Finally, let's assume that whatever you invested in after 2020 would earn 9%, the same as the QOF, and that you are liquidating in 2030 under either scenario. Okay, again, this is just so that we can compare apples to apples. And then finally, again, we're going back to the same timeline with the 6 years out on the initial capital gains tax, and then a total of 10 years out to trigger the benefit of ultimately the step up in basis for holding on to the QOF at least 10 years. So in going through these benefits, first note that with a QOF, no tax is paid in 2020. In a traditional investment scenario, you would have sold whatever your asset was and then paid the tax for that tax year, and you're already out $287,000 to reinvest back in 2020. Second, you'll see that with a qualified opportunity fund, the taxes are not paid until 2026, and that the taxes are actually 10% less than the tax bill you would have paid in 2020. And really, you're not actually probably writing a check for the taxes until the spring of 2027. So the first benefit in the scenario of the QOF investment, no tax paid in 2020. Secondly, you're deferring the taxes till spring of 2027, but you're getting a 10% discount. Third, you'll see that in the year 2030, there is no additional capital gains tax bill with a QOF because, again, in a QOF, you'll receive a full step up in basis for your 10 years of investing. And as I mentioned earlier, that step up in basis wipes away any depreciation or any depreciation recapture taxes you would otherwise pay. And for those of you who are in the know about depreciation recapture, that is actually a higher tax rate than traditional capital gains. Now, at this point, when you compare the dollars, the combined result of the tax deferrals and the tax discounts, even if both scenarios were earning the same 9% annual return, you end up with $422,000 more in 10 years than if you had paid regular taxes in not doing a QOF. Obviously, real estate development has a different risk profile than most other investments. And 9% is just a number used to illustrate the difference in tax consequences. So I'm not trying to, compare apples to oranges here. We're just assuming that you would have invested in something else that earned 9% for comparison. But unless you are confident that you could generate a significantly higher return than a portfolio of 2 or 3 QOFs, the difference of $422,000 in taxes should get your attention. And that especially is compelling when you started with $1 million to begin with. At 1031 Capital Solutions, our exclusive focus is helping clients invest in tax-efficient real estate programs. And most of the properties we sell are packaged as DSTs and QOFs, and occasionally some REITs and limited partnerships. Our first line of due diligence defense comes from our back office compliance team at Concord Investments. Like I mentioned earlier, they are the top broker of syndicated real estate programs in the country, and their vetting process for QOFs and DSTs is second to none. Secondly, my partner and I conduct our own extensive due diligence, and even though we may be able to sell a particular offering, we may not feel that that investment is necessarily suitable for you as an individual investor. Admittedly, there are fewer QOF programs on our platform than DSTs, but really that's because we have a very selective due diligence screening process. And we only work with the top sponsors in the industry, sponsors being the term we use for the institutional real estate operating firms who create and manage these real estate investing programs. Some of the factors that we consider and that you should consider in vetting a QOF include: one, is what the sponsor is doing inside the fund what they normally do in the course of their business? In other words, are they experts in the underlying investment? Two, does the sponsor have the infrastructure to handle all the investor relations and compliance requirements that come with a multi-$100 million investment fund? Three, with regard to track record, does the sponsor have a proven history of being able to execute the strategy within a tax-efficient vehicle like a QOF or DST or REIT? Four, is this a single asset or portfolio strategy? Jason and I really prefer building portfolios for clients, and in QOFs, we like to see that the fund is investing in multiple projects. We are big believers in spreading your eggs around into multiple baskets. And five, we want to see that the sponsor not only knows how to build or redevelop a project, but more importantly, knows how to manage that property after it's built. As a 10-year QOF investor, your hold period is going to last for years after the project is completed. And so you want to know that the managers know how to maximize revenues and optimize expenses over the time that you are holding that investment. So now that we've covered the basics of QOZ investing, I'd like to take a few minutes to answer some of your questions. But before we do that, I want to ask Alexandra to step in and do a quick poll of the audience so that we can get more information to the folks who are interested in having us follow up with you.
Yes, thank you so much for that. Very interesting. I learned quite a bit actually. And looking here at the screen, you'll probably see a survey come up if you want a complimentary consultation. with Rick or Jason or someone on his team, they can give you a little more clarity as to your particular situation. But in the meantime, I think we can start covering a couple questions while we get this one answered. So I'm seeing questions about minimums here. Are there minimums in terms of how much money you need to invest in a QOZ or a QOF?
There are minimums, and they do vary from fund to fund. For some of you may be familiar with the typical minimums on, for example, a DST. Most of the time, that's $100,000. There's generally similar minimums on QOF funds, but they do vary. So I wouldn't want to discourage anyone, from inquiring more based on what you think you may need to defer. I have seen minimums as low as $25,000 for a QOF. So, this is not something that that you're going to invest a couple $1,000s into to defer taxes on a mutual fund that you sold. There are a little higher minimums as a private placement.
Okay, good to know. Also as well, someone asking if they can only invest the capital gains portion of the proceeds or more than that.
That's a great question. You are not restricted to invest only your capital gains. If you had sold a property or an asset and wanted to invest more than just your gains, you are free to do that. We would love to have you invest more with us. There's no requirement. The tax rule is that you are required to invest all of your gains in order to get the tax benefit, but you can invest more or less than your gains, based on your preference.
Okay, great. And someone else asking, I think, a good question about fees, because there's always fees, right? Asking about whether or not those fees could ever get eaten, or the profits could ever get eaten by the fees that might be involved with something like this.
Yeah, and again, I have to speak generally because the fee structures vary somewhat from fund to fund. But in all of the types of programs that we offer, you basically have three categories of fees. Excuse me. There's the upfront acquisition costs. There's the management fees along the way, and then some kind of disposition fee. When a deal liquidates, and the sponsors of programs like DSTs and QOFs generally make most of their money on the front end in the acquisition costs and in the disposition fees, and less so in the operation costs. And so what you have are, in any of these structures, are the fees are baked into the price of the offering. So you're not going to see a deduction of your initial investment by some kind of set of fees and then have a reduced investment amount. Instead, what you have is you are investing in a project where all of the costs, including paying my commission and the syndication fees and the fees that the sponsor collects, are already factored into all the numbers. And so when they provide projections on distributions, that's net of all of the costs, taking all the anticipated revenues and all the expenses and their fees. And so part of my job is to sit down with you as a prospective investor, walking through the PPM so that you can understand what those costs are. And yes, of course, ultimately, the distributions and the total return are affected by the fees that otherwise wouldn't be paid. But that is that is all baked into the pro forma, and so you can see on day one before you make an investment what all those costs are and how the sponsor anticipates those expenses are going to ultimately impact the total return on the property.
Good explanation there, pretty thorough. Michael's asking, if I inherit a property and sell it, do I still qualify for this?
Well, without stepping into giving tax advice, generally speaking, when you inherit a property, the value of that property is stepped up to whatever its value was at the time that your parent or grandparent or whoever willed you the property, whatever the value was at the time that they passed away. And so for folks who have just recently inherited property, it's generally the case that it is not typically necessary to do either a 1031 exchange or other tax deferred strategy, because there has not been much appreciation from the time that your parent or grandparent passed away or spouse to the time that you're considering doing an exchange. Now, if it's been 10 years since you inherited the property, that's different. So you have to just treat the date of the inheritance as the date of acquisition, as if you bought the property on that date. What was the value of the property at that date? And whether there's been any appreciation since the date of inheritance, that would drive your decision of whether or not you're going to incur capital gains taxes, and therefore whether or not you want to do an exchange or invest in QF. So I can't answer that question without knowing how much appreciation there's been in that asset since you inherited the property. But I'm happy to talk to you about it offline, and if I have some numbers, I can give you a more specific guidance.
Yes, of course. TJ here has a couple interesting questions asking if an investor in a QOF can take distributions to live off of.
That's a great question, and each QOF has a slightly different strategy. So let me point out that in every QOF, there is an initial period of development or redevelopment where there is not going to be a significant amount of distributions, or in some QOFs, any distributions, because you're coming in as an investor in a project that's well underway, but they are developing or redeveloping properties. Now, there is one qualified opportunity zone fund that I'm thinking of that actually is paying distributions right out of the gate. But most of the time, you're going to have to wait a couple of years for the distributions to really kick in, because they are developing or redeveloping a project in the early stage. They might do a lump sum distribution like I described in the illustration. And then afterwards, yes, the property is then going to produce, or the portfolio of properties is going to produce distributions much like a DST or a non-traded REIT does. And your share of those distributions can be offset by your share of the depreciation if applicable, so that it's usually tax advantaged income for most investors. Whether or not you can live off that income, again, depends on how much money we're talking about. But the short answer to your question is yes. Ultimately, all of these funds are designed after the first few years to produce an income from the underlying properties until it's sold. And again, you're looking at a 10-year timeline for liquidation.
Okay, I think you hit on another point that TJ was asking about here. So once they've developed the project, then it's sold. They don't actually manage the property after the development is completed?
Well, actually no. So most of the time, the fund is holding the property post development. Now, again, there are different funds out there. So a couple of different funds have different strategies. Some intend to hold the portfolio properties all the way, 10 years. Others may sell the property and then reinvest into a new project and start the process over. And in which case, even though you are investing in a fund, what you'd be seeing really is a project go to fruition and then start over and see that upswing in rents for some period of time, then a drop, a new development, and then possibly some more income. So this is why when it comes down to picking a QOF, part of my role is to help you decide what's more important to you. Are you more concerned about maintaining or at least the potential for having a steady income from the QOF and going that route with a fund that's going to have a more stable portfolio? Or are you more attracted to the upside potential of the development and are looking to get more of your total return from appreciation, in which case there are funds that are really driven more to have less income and more appreciation for your total return. And of course, there's slightly different risks between these different strategies, depending on the location, the type of property, and so forth. So unlike DSTs, where there's kind of a narrower spectrum of types of properties, the QOFs definitely have a broader range. And so it generates a little bit more work on our part to match our clients with the best possible risk tolerance and profile and income profile for the investors.
Okay, great. I have a couple of people asking about the book. I'm so sorry, I forgot to launch that poll there. If you do want a copy of Rick's book, I will definitely follow up with some of the people that left already to let them know that this is an option. Rick can actually mail you a copy if you want a hard copy. I think you also have a digital version. Is that correct?
Yeah, we do have a digital version, and if you just want us to email you a PDF, happy to do that. If you're like me, I still prefer reading an actual book. I spend too much time looking at a computer all day. The last thing I want to do is read on a monitor. But if you want a PDF, that's easy to send. But if you can wait a few days, we're happy to send you the actual book.
Perfect. So for anybody who does answer yes to this, an email will be sent out to you. So it'll ask you to either reply with your address, or if you want it by email, it'll be there. Okay, so I'm going to leave that up for just another minute or so that I could continue here. So is there any sort of guarantee that a QOF gives for the project completion and doing it within budget? Is there any sort of guarantees with anything like this?
No, there are no guarantees, and that's an excellent question. And at the end of the day, you are still investing in real estate, and you are really making a leap of faith, like any real estate investment, that the sponsor is a strong sponsor, that they have a good track record, that they know how to operate the funds, that they're making good decisions on sourcing the property, on the financing. All of the risks associated with institutional real estate are, as part of a QOF, just like they are with a non-traded REIT or a DST. And that's why it's so important to make sure that if you are taking advantage of the QOZ rules to invest in QOFs, that that you're making good decisions on how you want to create a little portfolio. Oftentimes we're putting clients in one QOF, but my default is to spread the risk and put you in maybe one or two or three QOFs, just like we do with our DST clients, to further mitigate the risk of concentration in any one project. And then some of the projects have multiple, or QFs have multiple projects within the portfolio, so you have sort of built-in diversification. But no, there are no guarantees, and which is why doing the due diligence on these PPMs and understanding what's happening inside the fund really is important before you make an investment of hundreds of thousands of dollars.
Of course, that's what you're there for. And do you see, and you mentioned that you have a couple, right, or a few qualified opportunity zone funds, and are there any in specific geographical areas that you're seeing that are sort of trending, or is it sort of just random?
Well, I can speak broadly. What we see in securitized real estate in general, for the most part, is that whether it's DSTs or QOFs or what have you, is that sponsors tend to invest in the states where, if they're good sponsors and they're good strategy, where the states are more landlord friendly than not. Often in states where there is no tax, like Texas and Florida, or low tax, Georgia, Tennessee, places like this. Places where the demographic trends are positive. In other words, where people are moving to Phoenix, people are moving to Dallas, people are moving to Jacksonville, and they're moving away from other markets in the Northeast, moving away, unfortunately, from all of the 3 Pacific Coast states. So, it's the combination of where there are strong economic and demographic factors, where there's a regulatory environment that's favorable to real estate development and ownership, where the taxation is positive. And more often than not, if you overlay all those factors on a map, you're going to see that those states that are positive in regard to all of that are more likely to be the places where, for us, where you're going to see investment opportunity than not. And so it's the same types of states where you see the DSTs investing tend to be the same places where you see the QOFs. And if you, like me, have strong preferences about certain states, then that's part of the calculation that we'll have. And you can say to me, Rick, I really don't want to invest in, name the place, and then we'll make sure that, that we're avoiding that, whether it's a DST or a QOF investment.
Okay, yeah, I think that makes sense. And there are quite a few more questions, about 20 more questions. I don't think we'll have time to cover all of these, but I kind of want to finish with a question of my own. And I'm curious what you see for the future of Opportunity Zone funds. It seemed like initially it was a bipartisan sort of agreement. Now, with the Biden administration, I've heard some rumors that maybe things may change with 1031. Or do you see any changes also maybe occurring with Opportunity Zones? Have you heard anything about that?
Sure. Well, we have heard rumblings that that now that people have taken a closer look at what's gone on with the QOFs, that the feeling is that that this represents a tax benefit that to accredited investors who naturally are at a different socioeconomic level than other folks. And if you can afford to invest in a QOF because you've deferred a highly appreciated asset, then you're probably somebody who socioeconomically is has a target on your back with the Biden administration. And I think people are forgetting that the tax break is there to drive behavior, to redirect capital into these qualified opportunity zones. Now, I said at the outset that, because of the political nature of all this, that there really are zones where development was going to occur, whether there was a zone boundary or not. And so I think there are some folks, right now in Washington who are questioning whether the ultimate effect of the qualified opportunity zone law is going to be, bettering poor neighborhoods, or is it really just, going to be a tax benefit for the investors? From my point of view, is I'm not here to pass moral judgment on the result of the law. I just look at it as, an opportunity for my clients to defer taxes and invest in, in good risk-adjusted real estate. So today, the rules are in place. They can't be retroactively reversed. And so if you had invested in a qualified opportunity zone, or you do this year, even if they decide to stop future qualified opportunity zone investing going forward, that wouldn't affect your investment this year. So there's two senses of urgency. First, as I mentioned, for anyone who had a previous capital gain recognition, we have until the end of this month, going back to October, and so there's urgency there just to get in the door on this IRS extension. Then for this year specifically, this is the last year that you can invest in a QOF and get that 10% discount. I don't think, to your point, Alexander, I don't think the Biden administration is interested in extending the benefits of QOFs going any further. So this may be the last year, effectively, that we see the benefit from this subchapter Z for new investors. Now, on 1031, that's different. This is the 100th year of anniversary of 1031 exchanges.
Wow.
And it has survived decades of politics. And despite the fact that there's a couple people in the Biden administration who, have been vocal about 1031 exchanges, it is so integrated into our real estate economy that it would be so devastating to get rid of 1031 exchanges that it's not being considered. And it would require the House of Representatives, the Senate, and the White House to all approve a change in 1031 law. And there's just no way that the Senate could possibly vote to repeal or modify 1031 exchanges. So the name of my company is 1031 Capital Solutions. If I was worried about 1031s going away, I would be sweating it, but I am not. I am
Okay.
not. So 1031s are here to stay, and the QOF investing opportunity is here for this year. And so that's really, our message today is take advantage of this opportunity while it's here, because next year, to your point, Alexander, it may not be around anymore, but 1031 certainly will.
Yes, and just to reiterate, the March 31st deadline is for what?
That's for the folks who sold any kind of asset going back to October 4th of 19. So let's just say in November of 2019, if you sold an asset of any kind and you realized some kind of gain, even if you already paid the taxes on that, you could still go back and amend your return. I know it's a hassle, but an hour's worth of time for your CPA to redo a return could save you, in our example, hundreds of thousands of dollars of over time. So it's worth considering. And then if your gain was maybe say March of 2020 and you still haven't filed your taxes yet for 2020, we really have an opportunity to kick that capital gain tax payment down the road to 2027. So I encourage everyone on this call, look back, think back on the last year, 15 months. Did you sell anything that you're going to pay taxes on? And if it's a big enough tax bill, it's probably worth taking a look at the QOF opportunity. Also, if you had a 1031 exchange that got blown, or you realized after it was too late that you couldn't do an exchange, a QOF is a good replacement opportunity for a 1031 exchange. Not as great tax benefit as a 1031 exchange, but certainly a good second choice.
Yeah, absolutely. So you heard it, folks. You got 8 days to contact Rick and his team to get that set up. And fortunately, QOFs are a lot easier to set up than a 1031 exchange in terms of timing. So you still have time. It's still possible. And with that, we're going to end and conclude this webinar. Thank you, everyone, for joining. Please take the exit survey. We'll send you the recording tomorrow along with Rick's info. If you said yes, you want a book, we will follow up with you on that as well. So thank you so much, Rick. I'm looking forward to having you back in the future.
We'll be back in a couple months. Thank you, Alexandra. Thanks, everybody.
Bye.
Have a great day.
Bye,
Bye-bye.
everyone.